Welcome to the deep dive video update. And I always want to explain this. My context for deep dive is a little bit different than maybe what you thought when you saw this video if you're watching this for the first time. I do a number of videos throughout the week. I do a video each day. I do a number of weekly videos. At the end of those videos, I go through and I pick out some charts that I really didn't talk about in any of the daily videos. And I put them into this video because sometimes we can still get some insight by looking at this. There are also additional videos that are included only in this video, mainly for informational purposes. This is being prepared for Monday, November 4th. I do have a thing called the SPX Investing Program. Feel free to check that out. It's free until the end of 2024. There's a link below this video that will take you to the website as well as to a video that talks more about the program. If you have any questions, you are more than welcome to email me. Also, the daily video is the real foundation of the analysis that I do. This deep dive video is one of the outside videos that are meant to tie into the daily video. The first chart that we look at is a chart of the VIX, which has really been going up lately. You can see over on the right-hand side. Now, the VIX is on here, but the blue line that you see is a 50-period moving average of the VIX, just to give us an overall idea of the general range. Typically, when the market's going down or we're in a bear market, the VIX will go to a higher range. When we're going up, like down here, and what we've been seeing in 2023 into 2024 is an overall lower range, and that typically happens when the market is more positive and in a longer term uptrend. I did show this recently in the past week after Thursday's session. We measure how fast is the VIX going as measured by the RSI based on 9 periods. And we did get quite close to the 70 level, actually a little bit above it. But since then, we've been coming back down. Since I only showed this chart one day this past week, I decided just to show it in this video as well. And we're coming back down and getting a lower reading right now. I was showing this chart for it seemed like a couple of weeks. This is a correlation between the VIX and the S&P. When we get above this dashed line, that means the market is getting nervous. We just recently set an all-time high with the S&P a little over a week ago, but the VIX was giving a very high reading at that time, and this chart was picking that up. And since then, we've really dropped off, and a lot of this drop came when we went down in Thursday's session. We look at the VIX, and then there's another indicator of the VIX called the VVIX, or the volatility of the VIX. And typically, when this is going down, that can quite often be positive for stocks, but there's other times when we've seen this going up, and that can be somewhat negative and sometimes positive. So there's not a real clear-cut rule with this, but lately we've been going higher as we've been seeing the VIX going up in relation to the VVIX. We keep an eye on the volatility of stocks and the volatility of bonds. That's the VIX and move ratio here. We're both quite volatile right now. Bonds have been going down. That pushes volatility up. The VIX has been giving a high reading and then even went up further when we saw the decline this past week. So we're coming in right about at the moving average. And then I often show this. This is a ratio between risk on, folks are buying more aggressive stocks, versus risk off, where they're getting into more conservative stocks. But we're not really seeing any real movement here. It's been pretty choppy over the last few months. So I've dropped this chart for showing it in the daily video. If we really start to move in one direction or the other, then I'll start to show this chart again. We look at a ratio between large caps and small caps, also pretty much chopping sideways right now. We want to see some kind of a divisive move, or decisive move, I should say, either to the upside or to the downside. Then going back to the previous all-time high that was set in January 2022 and where we closed on Friday, we're still up 18.89%. Stockcharts.com has technical alerts, and this is for the whole week. If it's red, it's negative. If it's blue or green, it's positive. And we saw some things really going down red as the market is kind of shifting. Then we saw some positive things as well. So kind of at a glance, you can get a look to see, are we turning more positive or are we turning more negative for that particular day? Also, Stock Charts has this thing called technical scores, and you can do this with stocks, sectors. I do it with indexes, where I look at 5 indexes, the S&P 500, the Dow, the Nasdaq 100, the mid caps and the small caps, and then rank them on a score of 0 to 100. And coming in first, even though it came back up a little bit on Friday, but it's been dropping off, are the QQQs. And that's more encouraging. When this index is doing better, that's when we have a better tendency for both the Qs or the Nasdaq 100 and the S&P 500, because those stocks are included in the S&P 500, to actually go up. So we're coming in at 82.5. When we're really strong with any of these indexes, we get up into the 90s. In second place is the S&P 500 coming in at 81.2. That has more stocks in it and also more value. So when we're going up, this may underperform, but when we're going down, this tends to hold up a little bit better. In third place is the Dow, which is made up of 30 stocks, and it's coming in at 72.6. Then we have small caps at 67.2. And in last place this week are the mid caps coming in at 53.8. We look at a short-term chart. This is a rainbow plotted with moving averages going from 10 periods up to 50 periods. And we had been pretty solid. We were above all the lines, and the lines were still going up as well. That just showed that the short-term trend is positive. Well, we've dropped back down below these moving averages. So we're now negative in the short term. If we don't stay here very long and we're able to bounce up out of that, then the lines would continue to go up. If we see further weakness below the rainbow, this could actually turn over and turn the short-term trend more negative. Then in the intermediate term, I have another rainbow going from 50 periods up to 100, coming down to the top of the rainbow. So the lines are still going up. And for right now, we're still positive with the intermediate term. Then we've been looking at the 50-day moving average, which is my definition of the intermediate term, and we're still above that, so we're positive there. If we drop below that, then we're going to be watching the 100 period moving average here, which is still going up, and this trend is still positive. Standard deviation starting to pick up a little bit as the S&P has been coming down. This doesn't measure direction. This measures speed of how fast the S&P 500 is moving over the last 10 periods. It had been quite low. As we're seeing things a little bit more volatile, this has been picking up, but we're still below the moving average. If we go above the moving average, then I'll start to include this chart in the daily video. The mass index is not generating a signal right now. The Pring bottom fisher is also going down and not generating a signal, so I haven't been showing these last two charts. Then we look at a chart that measures how far away are we from a 20, 50, and 200-day moving average. When we get extreme, we use this like an oscillator, where we get extreme positive or negative. We're coming down and actually turning more negative in the short term. We're still slightly above the midpoint with the 50-day moving average. That's the intermediate term. And we're coming down, but still well above zero here with our distance away from the 200 period moving average. I only show this chart when we're getting either extreme positive or negative, and we're not there now. So I haven't been showing this chart. Then I show this chart off and on. This is a 19-day exponential moving average of the advanced decline ratio. And we're dropping negative, both based on price and volume. But there's another chart that I use, and that's also been turning negative. So I haven't been showing this. And price and volume right now are confirming each other turning negative as well. And the 19-day advanced decline ratio is more short term. Then we look at the Amex, NASDAQ, and NYSE and look at a 5-period moving average of the highs and lows. Coming down here in its reading, but it's still positive. If we drop over negative, that would mean that things in the broader market are also starting to turn more negative. The distance away from the 200-day simple moving average did fall off this past week, but we're still about 9% away from that. This number is hard to read. Could be about 6%. And then just measuring where we were a year ago and how far up we've gone, we're still up 28.3% from the October 2023 low, even though we're coming down right now off of these highs. Connor's RSI, I use this like another type of oscillator looking for extreme positive or negative readings. With the big down day we saw on Thursday, we almost got down to this lower black line here, but not quite. So I didn't show that then. and we're coming back up more to the midpoint right now. Look at anchored moving averages and have a number of them plotted here. And since we're coming down, we'll be keeping an eye on this chart to see if one of these moving averages, which moves forward as opposed to looking backwards with simple and exponential moving averages, to see if one of these lines ends up acting as support. But for right now, the takeaway is that all these lines are continuing to go up, and that is positive, and price is still above all of these anchored moving averages. The CMB composite, I also use this like an oscillator. It is negative and going down, but I'll really only pay attention to this if we go above the black line or below the black line here, meaning an extreme positive or negative reading. The percent B, we dropped below the midpoint. We did not close outside of the lower Bollinger Band here. We were close, but not quite there. And so this is just another way of using an oscillator combined with Bollinger Bands. Ichimoku cloud, still looking positive here, even though we're seeing some weakness. Now we're still above the cloud, and if we come down, the cloud could act as support. But then there's some studies placed on here where the blue line's still above the red line. That's positive, but the blue line is coming down. If we cross over, that would turn things more negative in the short to intermediate term. The green line had also been going up here, but starting to come down as well, as we've been seeing some weakness. We have a point and figure chart, no new X's or O's that were drawn. We're still working off of a double top breakout that was generated on September 19th. This chart is still looking solid though. We have X's going up and we have blue trend lines underneath here as well. We want to keep an eye on the S&P 100 and compared to the S&P 500. They both have been under pressure lately, not really seeing any divergences here. Then we have a long-term rainbow going from 50 periods up to 250 periods. We're just coming down to the top end of the rainbow. And this just suggests that the long-term trend is still positive and all the lines continue to go up. Another long-term oscillator is the Special K. We've been positive now for all of 2024, so I don't show this chart. I'll just mention it if we see an actual crossover above or below the moving average. Then on top of this chart is a weekly version of the S&P 500 and a weekly version of the German DAX, the biggest stock market in the EU. They're having a pretty strong correlated relationship right now. This doesn't measure if they're going up or down. It just says that they're going up or down together right now. And here's another look at the Ichimoku chart. For some reason, I included that twice. Support and resistance, we did set a recent all-time high, and so I marked down these 38.2, 50%, and 61.8% retracement levels. Even though we've been declining, we're still far away from this level. Now, if we keep going down, I'll be showing this chart a lot. If we go back to the upside and actually set a new all-time high, I will readjust these levels. Then broad market, where I really focus on the VIX because I do pretty much everything around the S&P 500. The Vixen is the volatility of the NASDAQ 100. And there's some kind of crazy data here. You get some really weird readings. So if I ever look at this chart, which I do look at it every day, but I mainly look at the line chart here, which is the closing value for the Vixen. Then we look at a ratio of the Qs to the diamonds, and we compare that with the S&P 500 and see that the relationship between the two is pretty much neutral right now. We want to keep an eye on the transports. They've been improving a little bit lately, but for most of 2024, they've been chopping sideways. The black line here is the Dow, which did come and set a recent all-time high a little over a week ago. But we want to see this red line above the black line and actually going up to be more positive, and it just has not been doing that in 2024. The bank ETF is still in an uptrend, even though we've been seeing some recent weakness here. And then we look at a ratio between regional banks, which are smaller banks, and the financial sector. And this is chopping more or less sideways, and it's still in an uptrend with this ratio. What we're looking for is a big move to the upside or the downside, and we're not seeing that right now. Some rated change charts, I use these for informational purposes. We had been looking pretty solid here, but we've seen a recent drop off. And this compares Friday's close with 250 periods ago. Here's a longer term look at that same chart. We get a little bit nervous longer term when we go above this blue line, but we can go far above it. But we're actually starting to come back down to the blue line right now. So the long-term trend is still positive, but if this really starts to drop down, that means the longer-term trend is turning more negative. We keep an eye on bonds. We look at a ratio between TIPS, which are Treasury inflation protected securities, and compare them with 3 to 7 year bonds. Now, in 2021 and into 2022, when this was going up, that's because interest rates were going up and inflation was going up. Then we finally got a handle on that, and this ratio has been coming down, and we've been chopping more or less sideways. But as interest rates have been going back up, we're seeing this ratio going back up as well, enough to generate a recent golden cross here. So this is a little bit of a concern, and we're trying to pick out what is actually changing in the environment. And we could just be switching more to a higher interest rate environment, which is different than what we've seen over the last 40 years. We look at the long-term bond ETF, which is in blue, and then compare it with the S&P. And then we look at a long-term correlation, which has been weakening, but starting to bottom out here, where the short-term correlation is a little bit stronger. And you can just see that over the last few sessions, they both have been going down. And that's why we're seeing a bit of an improvement with this correlation. We do the same thing here with the QQQs to the long-term bond ETF, except it's red on this chart. They're having a pretty strong tendency to go in opposite directions right now. And you can see where the black line's been going up as the red line's been going down. We look at the US 10-year yield and we subtract the German 10-year yield, and we plot the US dollar index. And believe it or not, there's actually a pretty strong correlation between the two. And this just tries to measure the interaction between yields or interest rates and currencies. And it's pretty solid right now. We keep an eye on the 2-year Treasury yield, which had really been dropping. Now it's starting to go back up. Sometimes when this spikes up and comes down, that will give short to intermediate term support to the S&P. Keeping an eye on the 2-year yield curve, I mention this in every video, but I don't show the chart because we've gone back to being uninverted now. We crossed back above this blue line. And even though we're coming up closer here, we're still inverted with the 10 to the 3-month yield curve. Then I have some things called possible positive scenarios. This takes the stocks inside of the S&P 500 and to see what's above their 200-day moving average. And when we get a really high reading, we use this like an oscillator for extreme positive or negative readings. Even though we're coming down here, we're still above 50. So the longer term trend, according to this chart, is still positive. Then we do that same thing with stocks above their 50-day moving average. And we're seeing a little bit more weakness here as the S&P has been testing its 50-day moving average recently. Then just to get a little bit broader perspective, we look at the mid caps, which also been under pressure lately, and the small caps, which are back to being under pressure as well. So thank you. I hope you found this helpful. I hope you feel free to check out the daily videos, especially, and some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.